know you guys don't have a lot of time. The fact that you guys sat down, clicked this video to watch me says a lot. There's a big chance that you guys want to learn how to trade because you are tired of somebody else being in control of your money, telling you when you're going to get paid, when you deserve a raise, when they're probably sleeping with the secretary. Like, I totally understand that, and you guys want to take matters into your own hands. So that deserves a round of applause right there in itself, because I can relate to that because I've been there. I've been there, which is completely broke, having no money in my bank account, to being a multi-millionaire, the private jets, the mansions, the penthouses, the wife, the kids, you name it, there's a big chance I probably have it. So I understand what it's like to be where you are right now, which is going on YouTube and typing how to day trade. So we're gonna get right into it because there's a lot of videos online that try to teach you how to trade in 5-6 hours for retention. It doesn't take that long, right? I don't know how long this video is gonna be, but I promise you I'm going to try to make it as quick as possible. And if you guys hear me talking fast, it's because there's the most and the biggest thing you guys could pay me with right now is your time, and I don't wanna waste it, right? So most importantly, right now we're gonna focus on Forex in particular. So people may ask, what is FX? And it really is just a market. There we go. It really is just a market where you can trade currencies, right? What is currency? You have it in your wallet right now, a single dollar, a single US dollar, a single euro, right? Whatever it may be, right? And what Forex is you're basically putting two countries against each other that have their own exchange, which creates an exchange rate, right? So look at this. You have the US dollar, you have the euro dollar, you have the pound, you have the Japanese yen, whatever it may be. When you get on a plane and you go land in Japan, you can't pay for things in the US dollar. You have to exchange it for the actual Japanese yen, right? That's literally Forex in a nutshell. How do you make money? By literally predicting on if the market will go up or go down. That's it in its purest form, right? So we look at this like this, right? And you guys won't understand this number just yet, but maybe in about 60 seconds you will, right? So if you see this, right, and it's literally like this, and you think the market is gonna go up from 1.30 to 1.31, and you buy it when it's here, and it goes up, you make money. It's that simple. When it does the opposite, you lose money, all right? So what does this actually mean, right? So let me actually put it down, right? So GBP/USD, right? So what does this mean? The Great Britain pound, the US dollar, right? So you put it like this. So when you see it like just like this, which is a currency pair right here, and you see a number like 1.30, like we put above, all that means is 1 pound is equal to $1.30. That's all it means in its simplest form, right? So again, you can go from, you know, Great Britain to, you know, the United States, give $1 or a pound, and they give you $1.30 back, and then not spend that $1.30 at all, and then you can go right back to, you know, the Great Britain at the end of it, right? Go to London, X, Y, and Z, and exchange that money back. There's a big chance it won't be $1. It may be something completely different, right? And I don't mean different, it could be just a little bit more or less, right? It won't fluctuate that much, right? Now, again, in terms of actual making money, right? So GBP USD is at 130. If it goes from 130 to 131, 132, 133, that simply just means it costs you more, or the 1 pound gets you more of the US dollar, right? So prime example, right? 1 pound equals $1.30. So if it goes from here to, let's say in 2 weeks, 1.40, and again, it won't do this because this is a big fluctuation, right? Like when you get into the actual chart, you'll see it go to 131, 132. It'll go in increments, right? But I'm just using this for, it's a clear-cut example. What if I gave you $1 and you gave me $1.30 back, right? And then 2 weeks later, I gave you that same dollar and you gave me $1.40 back, that means my dollar is worth more. So what does that mean? That means this is stronger in comparison to the US dollar. It grew in value. Now, if it goes from 140 to 120, which again, it won't do that because that's too far, but again, for simplistic purposes, you tell me my $1 that got me $1.30 last year only gets me $1.20 this year. What does that mean? It's weaker, right? So that's all you have to understand in terms of how to actually make money in this thing, right? In terms of what to actually do. Now, in terms of actually learning, I'm telling you, by the end of this video, you'll understand exactly when to buy, when to sell, you know, the actual sessions in terms of trading. A lot of you guys have this question where it's like, okay, well, if it seems that easy, how hard is it actually to learn how to trade? I'm telling you, By the end of this video, you'll learn how to trade in its basic form. The hardest part about trading is not understanding all of this and the charts, which we're gonna get to. The hardest part is actually putting your money and betting that the market will go up or down. It is not gambling. Gambling is going to Vegas and again, you're playing blackjack, you're playing X, Y, and Z, where you have no control over the outcome. You don't know what's going on. You're shooting dice and you're hoping it gets on a 7 or 11. That's gambling. There's like 5, 6, 7, 8, 9 reasons as to why we think something's gonna go up or go down. And someone may ask, you probably asked this to yourself 2 minutes ago, well, how do we know if it's gonna go up or down? A few things. One, there's 3 types of analysis. Number 1 is called technical analysis. I'll just put tech, right? But it's technical analysis. Number 2, fundamental. I'll just put fun, but it's fundamental. And number 3, sentimental, which I just put sent, right? What that means is technical is the charts. Everything you guys see on social media, the actual charts, like actually looking at a screen, that's technical analysis, which makes up, in my opinion, probably 90% of the market. You can be a technical, trader by itself with looking at fundamentals and sentiment analysis at a bare minimum. But there's some traders out there who are fundamental traders, which means you look at the news a lot, right? So how you trade is based off of what the news is actually saying, right? So prime example, GBP USD. Brexit happened, right? 2016, we started to hear about it. I think it was June 23rd, 24th when that announcement happened for the first time and the market just dropped. I mean, how I said this doesn't really happen, and I'm doing it for simplistic purposes, what actually happened is when Brexit actually happened and the UK decided to leave the European Union, I mean, GU went from 152 all the way to like I think it was 30, and then like a week later it went to like 120. Like it dropped dramatically. Why? Because the pound was weaker in comparison to the US dollar, right? There wasn't a lot of certainty and positivity and people believing in it at that point, right? So that's how you understand when things are gonna go down. So people may say, oh, well, if it's that easy and I would have made money, then why didn't everybody just sell GBP USD when they knew Brexit was gonna come out any day now? Because you can miss the chance. That's the hardest part about trading. Let me tell you a personal story really, really quick. It'll take 60 seconds and I'll get back into the video. I knew this was going to happen. I knew GU was going to drop. This was back in 2016 when I didn't have much money, but I just dropped out of college as a senior, right? Because I wanted to trade so badly because I just had my first $2,000 day. So I knew the possibilities of the market. Mind you, I was in college for 3.5 years at that point, and I had $2,000 in my bank account. I was like literally drowning in student loan debt. But then I just made $2,000 in a single day trading this thing. After some time of studying, I'm focusing on this full time because I can get rich, right? So what happened was I knew this was going to happen, and I was going to place an actual 2 lot, which you guys won't know, but remember the word lot in about 5 minutes because I'm going to come back to that because that's how you figure out how much money you're going to make or lose, right? And I was going to make about $20,000 to $40,000 as a broke kid because I knew G was going to go down. What happened that night? I met a girl. We went to dinner. We went back home. Some activities happened. I checked my phone at 3 o'clock in the morning and GU tanked. Completely tanked. Like I missed the opportunity because of a freaking girl. So this is what I mean about, you guys may ask, okay, why didn't you sell at that point? Or if it was that easy, you missed the opportunity. You could be at the gym. You could be somewhere and just miss the opportunity. Now, luckily I'm here because then I found out I can do things in advance. I can place types of orders, and that's actually the perfect segue to get into the types of orders right now before we get into, when you can trade it. Do I got to look at a chart, all the time, which you don't. But again, I didn't know. I thought I had to be on my phone 24/7 to actually click trade. The best part about trading, you don't. You can place pending orders. What is a pending order? A pending order simply means if the market gets here, get me in. So there's 4 types. There's market execution. So I'm going to put ME, which means the minute I click buy or sell, you get me in right now. There's a thing called a buy limit. So I'm going to put BL, which means I think the market is going to go up, but it's going to go down first, right? I think the market's going to go down, get to this level, which you guys will see on the charts when we get to technicals, and then go up, right? So if you look at, a buy limit, it just means I think it's going to get here, which again, this is why I say it's not gambling. You have so many reasons why it's going to get there. And you think, okay, it's going to stop there. A lot of people are going to take their money out of the market, and then people are going to, the bulls are going to raise it up, right? Again, get to a little bit later. So the market comes down. Now you're in the trade, and then it goes up. That's a buy limit. A buy stop just means the market is down, and the minute it gets up there, gets you in the trade, you're in. Same with the sell stop. It's going down. The minute it gets there, you're in the trade. Same with the sell limit in terms of I think it's going to get up here and then drop. It gets up there, you're in the trade, and it drops, right? So that's a sell limit. This is a sell stop. This is a buy stop, right? Again, we'll attach a picture on the screen so you guys can understand it because it's very, very simple to understand. What I'm trying to say is there's a reason why I'm teaching this now because I didn't know that. And had I known that, I would have made $20,000 or $40,000 when I knew GU was going to drop. So to answer your question, no, you don't got to sit at a chart 24/7 to learn how to trade. You can literally be at the gym. You could be sleeping. You could be at a wedding. You could be doing some activities, right? Whatever you want to talk about, right? And still make money in this market. What has to happen is you got to place one of these things like a pending order and say, when the market gets here, get me, if it gets there, get me in the trade. And sometimes you'll see after you're away for 8 hours, you check the charts and the market never went nowhere. It just was quiet, no volatility. It just stayed there. And then eventually you'll see, oh, okay, the market actually moved and it actually got you in, right? So now that you guys know that you guys don't have to sit at a chart all the time and you guys can still keep the quality of your life while still learning how to trade, let's get into the actual sessions, right? In terms of the hours. There's a big difference, right? You've heard of stocks, right? Now, the reason, and let's get into it real quick, the reason this gets a bad rep is not because of the industry. This is traded more than stocks. This has more volume than stocks, right? Stocks is about 20 billion per day in terms of the volatility, right? FX, 70 trillion, right? Way bigger, way much of a difference. The reason it gets a bad rep is because MLM companies came in and told you to do, oh, let's sign 3 people up who signed 3 people up and sign 3 people up and turn into a MLM, an actual little multi-level marketing. So people felt it was a scam. That's why this gets a bad rep, not the industry. The industry is a big difference and the industry is a lot better. Why? When it comes to stocks, there's about 2,500 companies, 2,400, 2,500 companies on the New York stock exchange, maybe I think an extra 1,000 on the NASDAQ, right? This is how many companies. Can you keep up with all of them, right? Like, you know how hard it is to actually keep up with this many companies? In trading, FX, just 7. Not as more, but in terms of the majors, just 7. There's like I said, there's little minor pairs, but for majors, there's 7, which is Euro, like the Euro, USD, USD Canada, USD JPY, so Japan, AUD USD, as in Australia, New Zealand USD, GBP, like we just did, USD, and then USD Switzerland, right, the Swiss franc. These are really the 7 of the most volatile in terms of like the most heavily traded pairs. And for beginners, I would say this is your core to start out with. Try to trade all of these pairs when you guys get the chance and you guys get on a demo account. See which one works the best. And then as your trading experience gets bigger and bigger, then you can dip into gold. Then you can get into crypto as well and actually look into Bitcoin. But do not look into Bitcoin because Bitcoin is so much more volatile than all of these things. Master this first. Get your risk appetite up first. See yourself losing money. See yourself making money. And see yourself actually being consistent at making money. Then dip your feet into gold. Then dip your feet into Bitcoin. Then dip your feet into things that are super volatile that you got to have a stomach for, right? Now, remember what I said a while ago where it's like, remember that thing called lot size, basically, right? So when I say have a stomach for, that's based on what you want, right? So there's a thing called lot size, which can work for you or against you. And a lot size basically just means like what you're putting on in terms of how you're going to make your money, right? So if the market goes from 130, like we said earlier, and then it goes from 130 to 131, and you put a 1 lot, right? Standard lot, which is what it's called, but a 1 lot, which is 1.00 lot. That simply just means this right here made you $1,000. If it goes from 130 to 132, and you have a 2 lot, right? This simply just means how much? If you guys said 4,000, you'd be correct. How's it 4,000? Because this was 130 to 131. This was 130 to 132. Now, if you said 2,000, I understand maybe this was tricky. If you use a 2 lot for this one, yes, you would have made $2,000. 130, 131, 2,000. But it went from 130 to 132, right? So a 2 lot times, we'll get into pips in a second, is the $4,000 you would have made. Now, what is an actual pip, right? So you look at this, 130 to 132, right? If it goes from 130 to 130, 100, right? Just the last three. This is 10 pips. It says 100, it's 100 ticks. And I know the terminology may confuse you. Just know that 100 ticks is 10 pips, 200 ticks is 20 pips. Nobody counts it off of ticks, right? They count it off of actual pips, right? Just divide it by 10, right? If it's 1,000 ticks, it's 100 pips, right? Nobody says, oh, it went up 1,000 ticks. They say it went up 100 pips, right? That's just some lingo, just so you guys can actually know. So if the market goes from here to here, right? This is 100 pips, right? So it's 1,000 ticks, 100 pips. So if the market goes up 100 pips and you have a 1 lot, you made $1,000. If you have a 5 lot, you made 5,000. You have a 20 lot, you made 20,000. Now here's where it could work against you. You have that same lot size and it goes from 130 to 129 and you were buying, right? If you thought that the market would get here, go from 130 to 131, so you bought it at 130, but it goes down and it goes over here and you had that same 1 lot and it went 100 pips, yeah, you're down $1,000. That's where this lot size becomes one of the most important things in this industry, because if you put a 0.50 and it goes 100 pips, yeah, you're up 500, you're down 500. You put a 0.10, right? Yeah, you're up 100, you're down 100, right? So the lower the lot size, the more your emotions are going to be okay, because you're not risking so much money. However, the slower your wins actually are, right? You know what I mean? So like, you can get 500 pips on one trade, but if you only have a 10 lot, then you only made $500. Whereas if you had a standard lot, then yeah, you actually made $5,000. So it just, as time goes on, you're gonna see the market, we get to technical analysis, you're gonna be able to decide, okay, this trade deserves a 5 lot. This trade deserves a 2 lot. This trade deserves a penny lot, right? A penny. And this deserves a 0.20, 0.40. And my journey from 2014 to 2016, when I was just starting out and learning, I lived between the 0.10s and the 0.40s because I didn't want to risk too much, right? I wanted to make $10, 20, 30, 40, 50, 60. And a lot of my wins were in the 70s, the 60s, the 50s, the $20, the $100. And it wasn't until, I was playing college basketball and we lost in the playoffs in the first round, 4 days later, where I didn't have 7 hours of my day killed because of, pre-practice workout, film, pre-practice shoot around, actual practice, after practice shoot around, after practice recovery, like ice baths and getting wrapped up, going to the cafeteria to eat and then showering, and I just had my full day free. My first week, March 10th, 2016, I made $2,000 in a single day. That changed my entire life, which caused me to drop out, right? So again, like I was you can see how if you're in between the 10s and the 20s and the 10s and the 20s and 30 lot sizes, right? The 0.10s, 0.30s, and then all of a sudden, you decide you're fully confident in what Euro USD is doing, and you're fully confident that Euro USD will go from 1.05 to 1.07. Again, this wasn't what I entered at. I'll put the screenshot of what I entered at. But you're fully confident, so you buy it here, and you put a higher lot size, yeah, you're gonna be rewarded, and that's when I got rewarded for my first $2,000 day, right? So now we are gonna talk about how long it's actually open for. Back to what we talked about stocks. Stocks is only open from normal working hours, right? Which is why people may say, oh, well, how can I trade stocks if I work a 9 to 5? Chances are you can't. If you work a standard 9 to 5, when the market is open from 9 to 5, basically, you can't, right? I mean, unless you're at phone or at work, right? At work on your phone, there's a big chance you can't. Here, 24 hours. Same as crypto, which makes it easy for you to still have your day job or still do your passion, still run your business, do whatever charity you want to do, and then you can still trade at nighttime. You can choose when you want to trade based on your schedule and based on the pairs you want to trade. Prime example, if you're somebody who stays up overnight, there's a thing called a London session where pairs such as Euro USD, GBP USD, they're more volatile. Why? Because GBP, because Euro, aka London, right? London session, right? So pairs like that will be the most volatile, where they'll move a lot. Then if you're somebody who likes to, work a 9 to 5 and then after 9 to 5 come home and trade, you can do that. Why? Because there's a session called an Asian session, right? An Asian session, which is basically, I know that it's like a Sydney session, which is like Australia, Sydney, and then Tokyo, but I just call it an Asian session together. It's basically from 6 o'clock, 5 o'clock, 6 o'clock, basically, PM, all the way to 3 in the morning, right? PM to 3 AM. Why? Because their day is starting over there. When it's like nighttime for us, it's their daytime over there. So their market is moving and moving and moving. So pairs like, USD JPY may move during this time, right? Even a pair like, even gold may move during this time, right? Things like that, right? You can look at New Zealand USD will move during this time. So that's how you figure out which pairs to trade. When you figure out what your schedule is and when you want to trade, you look at, I'm going to trade Asian session. Okay, maybe I should focus on USD JPY, AUD USD, and New Zealand USD because it goes with this session, right? London is more like 3 a.m. to noon. And then if you're someone who's like, well, I work at nighttime, so what do I do during the day? There is our session, which is New York session, which is basically our 9 to 5, right? Basically, right? I know it starts at technically 8, right? So I'm gonna put 8 a.m., but basically our 9 to 5 to 5 p.m. Right? Because our market is open during that time. You guys are going to work during that time. The market is open. The world is open, right? Normal working hours, similar to over here. That's when the market kind of opens up, right? Again, look at it. It's everybody's 9 to 5. 3 a.m. our time in New York, like EST, is the morning for London. So that's their 9 to 5, right? Same with Asian when it comes to 6 p.m. Our time, and same with New York. Well, for them, for our New York, when it gets to 8 to 5. And this is where pairs like, again, it can still be Euro USD because there's an overlap, right? As you see, this ends at noon in terms of London session, whereas this starts at 8 a.m. So that's why, in case you ever see an overlap, that's when the market is the most volatile, which is 8 a.m. to noon. Can you make money outside of this? Yes, because I did, right? I was never a New York, London overlap trader. I was always a London trader because I babysat at night to make some money, and then I was trading late at night into London session. Asian London's how I made my money. But nowadays, right, just so you guys can know as beginners, right, this is the most volatile session because London session is the most volatile session. That's why London is called the capital of Forex, right? London and New York, when they overlap, it's the most volatile overall session. So that's how you figure out what pairs to trade. You figure out what your schedule is or what you want it to be, and you figure out what session you want to trade on, and then you get the pairs from there, basically. Now, back to what we were talking about in terms of lot size and making money, and then we'll get right into the charts shortly. In terms of actually making money, people are so scared about, what if I lose this much? You only lose what you allow yourself to lose. What does that mean? You can break your phone. You could be going through a breakup or getting married, doing that, whatever you want to do where you don't check your phone. If you have a stop loss and a take profit in place, you will either make money or lose money. It's that simple. You will never blow your account as long as you have a stop loss in place. What is a stop loss? Exactly what it says. It stops your losses, right? Like, so if you are, let's say you're in a trade and, you are losing, you say before the trade, I don't want to lose more than $50. Okay? So when you're losing $10, you're still in the trade. You're losing 20, you're still in the trade. You're losing 49, you're still in the trade. And all of a sudden, it gets to 50 and you haven't checked your phone. When you get back to your phone, you will see the market got you out and you lost $50. You didn't have to close it out at all. It did it for you, right? But if you don't do it for you, then yeah, there's a big chance it can go all the way down to however much you have in your account and get your account all the way blown to zero, basically, right? So that's why I always recommend to trade with a stop loss. A lot of people who are more advanced don't trade with stop losses because they trust themselves. But as beginners, I recommend it. And then there's a thing called the take profit. What does that mean? It literally takes your profit. So if you're saying, hey, listen, which will happen a lot of times, and I'm telling you guys it will happen. A lot of times you guys will be in a trade and it'll happen overnight. You go to sleep, because again, for me as a London session trader, you go to sleep, you wake up and you see, I'm up $100. That's nice. right? Okay, that's cool. But then you look at the market and you really look at it and it's like, oh, I'm up $100 off a retracement. What is a retracement? Retracement means, let's say you're buying and you bought it down here and the market just goes up. Retracement means it's coming down, it's retracing, coming down. So you see, oh, I'm up $100. That's nice. But then you look at the market, you're like, wait a minute, the market got way up here? That means I was up $1,800 or whatever lot size you put on. So you're telling me I was up $1,800 and now I'm only up 100? Take profit basically means you tell the market, if I'm ever up $1,500 at any point in time, $1,800, $1,000, get me out the trade because I'm going to be asleep. And you wake up, and if you were ever up at any point in time $1,000, you'll see that the market, the money is in your account already, and the trade is called off because you got what you wanted, right? So always trade with that. Now, some of you guys may ask, how much money do I need to start trading with? I always tell people, again, more why to trade FX over stocks, because with stocks, you gotta have at least $25,000 with stocks, or you're subject to the PDT rule, which means you can only trade 3 times per week, which as a trader, you know you need to trade more than 3 times a week unless you're a swing trader. We'll get to that in a second about swing trading. Give me another minute. FX, you can open an account with $50, right? So you can really play around with it and see, you know, pause. But you can really play around with it and see literally on what makes the most sense for you, right? You can play around with it in the sense of, okay, $50 is not gonna make or break me. I can try things out and see, you know, if I really can do this thing or not, right? So it's an easier barrier to entry, which helps out a lot with your psychology overall. So when you look at it from that perspective, I'm not saying this is how much you should start an account with. I'm saying if you're a beginner, do a demo account, like fake money, right? Paper trade, fake money, until you understand, okay, buying and selling and going in that direction. Then put the smallest amount that you can deposit, $50 or $100 that you're cool with, and trade live, but not with the purpose of scaling up a large account. Just try to get some wins, try to understand, get the emotions under you, right? Understand, okay, like, I feel this way when I'm in a trade. I feel this way when I'm losing. I feel this way when I'm winning. Get that emotion in you, because it doesn't matter if you're losing $1, $6, or you're up $1, $10. It feels new. Why? Because you made that money playing Madden in 2K. You made that money while going shopping at Sephora. You made that money chilling. And you'll see that making $200 in this means a lot more than that paycheck you got from your job, because you know eventually this can surpass that eventually once you get good, right? So when you look at it from that perspective, how much money do I need to start with? What I would recommend is, again, like I said, demo, then start out low. If you guys have some money saved up, then okay, in terms of breathing room, I always would say anywhere from $2,000 to $2,500 to actually trade with. Again, you can actually trade with $50, but from my experience, the lot size, right? Again, $50, you have a standard lot, which means you're over risking. We'll get to the risk management part later. A standard lot, you don't even got to get to 100 pips to get stopped out, right? You don't even got to get to even 10 pips to get stopped out. You're stopped out on a standard lot. You're stopped out with what, 5 pips, right? You're stopped out real quick, right? Because we all know 10 pips is $100. So when you're looking from that perspective, it's like, okay, I can't really trade with higher lot sizes. Whereas over here, you can kind of get away with trading with a higher lot size to kind of give yourself some wins, some higher wins. And there's a thing called a prop firm, which we'll talk about in another video, where if you guys don't have access to this, then you can pay, let's say, you know, $250. And as long as you know how to trade and you can go through a test, a phase 1 test and a phase 2 test, and you beat the test, you'll get access to a $25,000 account that you can trade with, to where you didn't have to use this at all. All you had to do was pay this little entry fee and get through a test, which basically is like, you have to make 10% before losing 10%. As long as you beat that test, you'll get access to a $25,000 account. We'll talk about a prop firm in another video. But again, you don't need that much to actually start with. You just need to start, which is why in the beginning, I applauded you for actually taking a step 1 to getting here. And if you're still here with me right now, that deserves another round of applause, because you have passed phase 2, which is you're already halfway there to understanding how to trade. I just got to show you the charts, and you can actually see what makes the most sense. So I'll get to the charts in a second. Last thing I want to talk about is leverage. I could have kept this up here basically. So leverage just basically means when the market says you have a 1 in 100 leverage, That just means you can trade up to 100 times of what you have in your account, which is great. It can be against you sometimes in case, you know, you trade some heavy and high lot size and some high trades and you lose, right? But what this basically means is that if you put, you know, let's say you put, I'm gonna get my phone out because I don't feel like doing math in my head right now. Calculator. Let's say you started an account with $500 and you have a 1 in 100 leverage. That means you can trade as if you had a $50,000 account, right? That's basically what leverage means, right? So it's not like you're not gonna make much money with $500, right? If you have 500 and it's a one, and the broker offers a 1 in 100 leverage, the leverage is dictated on the broker. Some you'll see 1 in 50, 1 in 30, 1 in 200, 1 in 500, 1 in 100. What it means is, again, 500 times 100, you can trade as if you had a $50,000 account, which means you can make a good amount of money because they won't stop you in the lot sizes. Whereas, but you also could lose because they could go against you. Again, so what it also means is if you had a 1 in 30, leverage, a super smaller leverage, but you tried to trade as if you had $50,000 and put a super high lot size on a trade, you can't do that. It won't even let you enter. Like you would try to enter and the market would be like, cannot enter because you don't have enough leverage to actually get in this trade, right? So leverage, again, can work for you or it work against you. It depends on how you utilize it. And I think right now, since you guys already understand the basics, I think it's time to actually get into the actual chart work of technical analysis. So let me actually erase this and let's get into the actual chart video. So I'll actually use the other computer, not this one. Oh, I actually lied because this one's about to die. Okay, so we got to use this one. All right, so I'm going to pull this screen up in a second because, again, you guys have made it this far. And you guys see it's actually not that scary to actually learn how to trade. It just takes you some time, right? And the time is the, 20, 25 minutes we've been doing this so far. You put a good amount of these in, you'll be in a great position to where you're like, oh, this is actually a lot easier than I thought. Because for me, like I said, I am a multi-millionaire right now, and I wouldn't say it was easy, but it was easy in the sense of all I had to do was lock in, right? There was a lot of up and downs. There was a lot of like nights where I'm just like, this is crazy. I don't know if I got it in me. Not the trading, but just the distractions, right? Like just skipping every single party, never going to the club, never drinking, never smoking, never doing nothing, missing all the parties my friends was having with girls. I was just locked in my room. And that was hard sometimes. Dropping out of college and then seeing the year I dropped out, my basketball team won a championship. That was hard for me to watch, right? They all got their degrees while I'm babysitting and learning this trading thing. That was hard to watch, right? But I took the risk. And you guys got to be okay with taking risks because eventually it pans out because now I'm the successful one, right? So with you guys, when it comes to actually learning how to trade, we're going to share our screen right now, screen recording, and boom, now we're sharing. So you guys look at this chart as you see it. Again, not as difficult as you guys may think it is. But when you look at it from this perspective, you'll see that this chart, what does this actually mean? You see the numbers that we talked about over here? This is USD JPY. This is my actual chart that I'm actually trading with. So we're gonna have to actually go to a actual blank and empty chart. And let's go to GBP USD, but a blank and empty one. Let's use FACM, remove, right? So this is a blank chart, right? Let's actually remove the indicator too. A blank chart. This is a chart. This is called the Japanese candlestick. We're not gonna get into actual patterns right now, but in terms of Japanese candlesticks, I have a video on here. It's called a complete guide, Japanese candlestick guide, that you guys can watch as well. And you guys will see there's patterns that you can recognize, right? This is why I said you have so many reasons to actually get in. There's patterns you can recognize that'll help you decide on when to get in, right? This pattern right here, you guys don't know. This pattern right here is called an evening star. What does an evening star mean? When you see an evening star, that means the market's gonna reverse and head back down. It's one big green candle, followed by a smaller middle candle, followed by a red candle down. It's a 3 pattern, right? 3 candlestick pattern, right? What is this? This is a tweezer top, right? What does that mean? It's just one big green candle, one red candle that follows, which is pretty much the same body, and it comes straight down. Reversal candlestick, right? What is this? What is this? This is a doji, right? What is a doji? It's whenever there's indecision in the market, and a lot of times you'll see a reversal because it's indecision. So there's a lot of actual patterns to actually know. So please watch that video where I outline the full-on candlestick guide, because again, And if I can go back to over here, there's a lot of ways to actually figure out what's most important in the market. First thing is candlesticks. Understand the patterns, understand what to see. You guys will be like, oh, there may be a lot of patterns. There's only like 8 that you gotta like remember, right? And it may not even be that, right? There's head and shoulders and inverted head and shoulders, right? Then there's tweezer top, tweezer bottom, morning star, evening star. There's always an opposite to something, right? Tweezer top, tweezer bottom, right? Double top, double bottoms. It's like, it's real easy to understand it and remember it once you guys look at the actual patterns. But I don't think it's good to go over that pattern right now and have a whole video on it. I think I want to get to the next thing, right? So you see the actual numbers right here. So you see how much this dropped, right? Look at this. This is 134 all the way to 125. That's a drop. We were talking that if you had a standard lot, if it get from here to here, what we do? Oh, I'm signing up here now, but what we say earlier, 130 to 131. This is $1,000. This small move right here is $1,000 if you had a standard lot. So what is 134 to 125? About, if you had a standard lot, $9,000, right? As you see, that's 900 pips from 125 to 134. So you would have made $9,000 on a standard lot. On a 5 lot, 45,000, right? It just depends on what your lot size. This right here would have made you $45,000 with a 5 lot, right? With a 10 lot, you would have made $90,000. This is why it's so important to choose your lot size, because what you choose could be a difference maker between you actually making a lot of money and you actually losing a lot of money. But again, so you may ask, well, how can I lose a lot of money if I'm always having a stop loss at, $50 or $100? That's a good question. You won't. You will. If you say your take profit is $90,000 and your stop loss is $50, you can do that. The issue that comes with that is the market retraces a lot. So you'll see sometimes the market will literally retrace and your $50 stop loss will get stopped out, and you'll wake up in the morning and you'll see the market went exactly where you said it would go, but you didn't make the money because your stop loss was too tight. So the market stopped you out, and then it went down, like if you were to sell, all the way to where you said you would have taken your profit at the $90,000 or $50,000 or $20,000, whatever your lot size is, and you wake up upset because your stop loss is too tight. So there's a balance between giving your trade breathing room. You'll hear me say that a lot, breathing room, because that just means give your stop loss some breathing room from where your entry is. If you have it too close, you can do that and mitigate your losses and not have too big of a losses. But you see a lot of times you'll get stopped out because the market just is moving. I just see the market just moving, these small moves, and then it heads all the way down or all the way up. So now, after the Japanese candlestick, there's something called support and resistance, which is what I call key levels. What support and resistance is basically the market has been this, currency thing, exchange rate, FX has been going on for a long time. The market moves similar to what it did, years ago, months ago, weeks ago. It does the same thing over and over again, right? So you'll see, I kind of, use what's called like a quarter theory, which basically just means that every single quarter the market kind of really stops at. And you can see it in real life time. I don't got to make anything up. You can see it in real life time. The market usually stops there. Let's see at 130. What's a quarter? 127,500. Do a ray for that. 127,500. Let's bring it over actually a little bit. The horizontal line. 125. Let me just do the fives first, right? 125. 120 is way down here, so I don't gotta do it. Just go up here. 135. Oh, sorry, I had a straight one. I meant to do a horizontal line. I'll get back to that in a second. 135, 125. Let's take the straight lines out. Right. So now let's fill in the actual mid levels at 132.5 and 120. Oh, we got that one. Yeah, 122.5 over here. So now you'll see that price never stops at an exact number. So that's why we have areas for all of them. You'll see in a lot of people's charts, they have these things called areas, because price can go a little bit below, like it did over here, or a little bit above, right? Like it did over here. It still means it held firm, right? It still means it held firm. If I can go all the way back in time, you can look at this, right? At 125, just draw, boom, just drag it all the way over. And you can see as an area, I like my color to be purple, just because you'll see market stopped here, couldn't get below it, got here, hesitated, gave a doji, boom, pulled all the way up, bullish engulfing, which you guys will learn later. The market consolidated here. Consolidation just means the market is going up, down is not going nowhere, right? I like my consolidations to be right here like that. You'll see the market hesitated here, stopped here, got above, came back below, right? And it can go all the way back in time. I can do the same thing for the others, right? Let's look at 130. You see right here, stopped here, stopped here, stopped here. Drag it over. And you see all the way over here, same thing, where the market stopped here, stopped here, stopped here, stopped here. And the same thing above. I don't draw it on the mid-levels. Why? Because I feel like my chart would be too cluttered and ugly if I did. But look over here for 130 or 135. Market stopped, literally stopped here, stopped over here, stopped here, stopped here, stopped here, stopped here, stopped here. A lot of stops, right? A lot of stops, right? So for me, you look at it from this perspective where it's like the market usually follows structure. So we have our, key levels here. I can put the 120 here actually now. Yeah, we have our 120 levels here, or sorry, our key levels here, which is our support and resistance. What is support? The floor, right? Support is the floor, resistance is the ceiling. So if price can't break below this area and it's above it, that means price couldn't break support. If price breaks above this area and it's below it, price broke resistance, which now, since it's above it, it's now support, right? And if it's above it and it breaks through, price broke through support, which is now resistance. Does that make sense, right? If price is above it up here, anywhere below it is support. Once it breaks through the first level of support and it's in the middle, this becomes resistance, this becomes support. So now you have candlesticks, you have support and resistance, which is called moving, key levels. Number 3 is trend lines. The market moves on structure. So when it comes to trend lines, somebody may ask you, what is a trend line? You just tell them flat out. If I can go to over here, so the blank chart. You see my trend lines are, this is a trend line right here. See how it's placed here. Go over here, right? What is a trend line, right? So what is a trend? The market moves in trends, right? So remember I said consolidation? There's 2 trends and then there's consolidation. An uptrend is made up of higher highs and higher lows. So market goes up, high, down, higher, low. This low is higher than that low. High, this high is higher than that high. Low, this low is higher than that low. High, low. And you see, I drew it ugly, but you'll see that it's usually, when it's a lot cleaner, it's usually able to be connected by, sorry, there we go. It's usually able to be connected by, oh, that's ugly. Huh. Just delete that really quick. But it's usually able to be connected by a trend if I didn't draw it ugly, right? If I didn't draw it ugly, usually it's connected by a trend, right? And the same thing goes for an actual downtrend. What is a downtrend? Low, high, lower low, lower high, lower low, lower high. This is a low, this is a low, this is a low. Lower high because it's lower than that high, lower high, and then a trend line to actually confirm it, right? Again, I drew it ugly. And then there's the thing called consolidation, where the market goes up, down, up, down, up, down, goes absolutely nowhere. So you draw a box around it to wait for price to actually break out of the box and then trade in that direction, right? So that's trend lines. That's what you actually look out for, right? So let me actually delete all of this. So now we go back to our blank chart, or actually our chart that we were working on earlier. I think it was this one. Nope. I don't remember the chart I actually had it on. Yeah, this one right here, right? So you see we have our key levels on. We have consolidation here. Where's the trend line? Okay, trend line is right here. You connect the points. A, B, boom. You can see price is breaking the trend line now. And once it officially comes below, you'll see this trend line is considered broken, right? You can look at over just a lot of places where, okay, is there a trend? Is there a trend? You can see right here, there was a trend here to here, right? High, low, lower high, higher low, which means it's a change in structure. Because what we said earlier about a downtrend, high, low, lower high, lower low, lower high, lower low. But once you see prices in a downtrend, high, low, lower high, but then it gives you a higher low, which means an uptrend, that means structure is changing, and that's when you know if you're selling to get out the trade because it's about to turn around. Because you just saw structure just change. Bullish engulfing, which is a Japanese candlestick pattern, which you'll learn. Price gets above, higher low over here, which you can kind of place a trend line over here, right? And then finally price broke above this trend line, and now we are off to the races. So when it comes to trend lines, you got to be mindful of them. You got to use them whenever you see a trend, but also pay attention to actual market structure, right? This is all how you figure out how to trade. Why? Because if I was over here and I was wondering, oh, how do I get in? You know, how do I know I'm going to trade so far with just these three things? Oh, okay. Well, I have a market was in a downtrend, and if I could just bar replay this and go over here and actually, why would I get in? Oh, why? Because number one, price is in a downtrend. It was, and then we got this higher low right here. Confluence number one. Confluence, another word for a reason. Confluence number one. Number two, we got a bullish engulfing right above and headed right back above 125, which is our key level. Number two. So we talked on trend line, support resistance, and candlesticks. Number three, once this actually breaks through, which you can see it does if we actually click play. Now your confluence could be, oh, on top of that, price broke above a trend line. Number three. But number four is a thing called Fibonacci. I have maybe about 2 or 3 videos on Fibonacci on here, so I'm not going to get deep into the actual math behind it. But for the most part, price moves in cycles. So if I have my Fibonacci retracement on, and how you use the Fibonacci retracement is if the market is doing, when the market is in trend, every time you see the market go from up and then retrace down, get a Fibonacci retracement, because it tells you how far the market is going to retrace before coming back up, right? Same in a downtrend. Oh, it's retracing? Okay, where on my levels is the market going to get to before coming back down, right? So if you look over here, it's an uptrend, right? Boom, low, high, higher low, looking for a higher high. So you get it from here to here, A, B, C. Oh, these numbers help you indicate where price will get to before reversing. The most important ones are 38.2, 50, and 61.8. So the mindset is, okay, great. It's going to get here before actually reversing and coming back up to where price usually gets to, right? These negative 27 extensions and 61.8 are just levels to where price usually gets to after getting here, which means what? More profit for you. So how do you determine your take profit in general? On top of the confluences we had in terms of this trend line, and then on in terms of, okay, we have a trend line here, number one. Number two, we have a bullish engulfing breaking above our key level, number two. Three, a trend line broke, number three. Number four, we're officially in an uptrend, right? A low, low, high, higher low, higher high, which you'll get above here, right? Which is number four. Then we got a Fibonacci, which A, B, C, which lands on a 38.2 extension, number five. There's a lot of confluences to get in the trade. So then you do what? You get in the trade, right? And in this video, I'm not going to go over where your stop loss should be or where your take profit should be, just because I have videos on that, which we'll link right here as well. But for the most part, you can look at, oh, the 27 extension is up here and it lines up with my key level at 1.30. Okay, I'm going to get in this trade and I'm going to have my take profit at 1.30, which means if you would have got in right here at 1.26500 all the way to 1.30, what is that, right? That is about 350 pips. 350 pips, right? You have a standard lot size, and now you have made $3,500 on a standard lot size, right? Again, a 2 lot is $7,000, a 10 lot, $35,000, right? Just depends on what lot size you guys want to use, right? So that's Fibonacci. And then, oh, sorry, let me actually press play on that. And you see what it do? Got right to the 27 extension and right to 1.30. That is simply how you trade, right? Earlier, when you guys first started this video, you guys were wondering, well, how do I trade? And now you're at this point in the video where you actually know. There's obviously more deeper details to get into, but you guys know the basics of it. Okay, I look at the candlesticks and find a pattern. Then I look at support and resistance, aka key level, see where price is at. Then I use trend lines to tell me if the market's an uptrend or downtrend or consolidating. Then I use Fibonacci to look for my entries on where I should enter based on where the market retraces at. And the one thing you can look at as well is something called a moving average, which is an indicator. Moving average is basically just the average price of if you look at, if I get over here and add the 8 EMA, which again, I have a great, again, I have videos like these separated. I have a video on all of this by itself. Whoever's editing this video, show them, like, flash the screen. The candlestick video, the psychological level video, which is, you know, support and resistance key levels, the trend line videos, the Fibonacci video, and the moving average videos, right? You guys got a lot of studying to do, but it's good because it doesn't take that long as you guys may think. It's not that hard as you guys may think. You guys are this far in this video, it's not that hard. Moving average just helps you identify where the market is going to be. So you guys can see, let me actually put the 8 and the 14, right? So basically, to make it easier, you guys can look at this little line right here, and you guys can see very, very simply, it's an indicator, right? Where if the blue crosses over the red, like it did over here, we are in an uptrend. If the red crosses over the blue, we are in a downtrend. If the red and blue is right in the middle of price, we're consolidating, right? Just over here, we're consolidating. Red crossed over blue, what happened? We came down. Blue crossed over the red, what happened? We're pulling up, right? So you use a moving average. So again, back to all the 5 confluences I had early on in terms of why do I want to get in this trade. The 6th one could be, oh, on top of that, the blue crossed over the red moving average. So that's 6 reasons why I need to get in this trade. I'm going to get in. Guess what? All you need is 2. You only need two or 3, you know, entries to get in the trade. That's all you really need, are confluences. And you got 6. That is how you look at the market, and that is how you determine if the market, how the market's going to go from 1.23 to 1.30, which is 700 pips. And again, 700 pips on a 5 lot, $35,000. On a 10 lot, $70,000. On a 1 lot, $7,000. Right now, I do think I want to end this video off with risk management, which again is probably the most important thing. I mean, and this over here. So last thing I'll say in this video is risk management, right? Some people may say, oh, what if I lose more trades than I win? That is not important. What's important is your risk to reward ratio, right? So what that means is, if someone says they have a 1 to 3 risk to reward ratio, that means their stop loss is, let's say, 50 pips. What's 50 times 3? 150. So that means their take profit is 150 pips, right? And for good measure, if you look at it in terms of dollars, if someone says if they lose 50 pips, that means they lost $100, but 100 times 3. If they gained 150 pips, that means they gained $300, right? Boom. So how can you still lose trades and still make money? Here's how you do it. Move my font away. Here's how you do it. If you are someone who always keeps a 1 to 3 risk to reward ratio or higher, let's say even 1 to 4, you can lose out of 10 trades, 6 trades and still be profitable. Let me show you how. So let's say every trade you take is a 1 in 4 risk to reward ratio. That means, let's say your loss, your 4 losses, you know, is, let's say $250. Every time you lose $250. Every time you win, you make $1,000. So, and again, let's say you lose 6 trades out of 10, but you win 4 out of 10. 6 times 250 is what? You lost $1,500. 4 times 1,000 is you made $4,000. So your overall profit for the week is $2,500. Now, of course, that number can be widely higher, right? Because you guys can lose $2,500 every time if you have some money to play with, but you also can make $10,000 every time you win. So every time you know, if you still do the same math, you lose 6 trades out of 10, and your win rate is, my win rate is 40%. Win rate means nothing because you can have a win rate of 40% and still be profitable. People out there have a 60% win rate and they're barely profitable, right? Because they're trading 1 to 1 risk to reward ratio, which means you got to win at least 6 times out of 10 just to be profitable. If you win 5 and lose 5, you're breaking even, which means you made 500, you lost 500, so you're at 0, breaking even. But with this method, again, back to if you went to the 2,500 route, you could 6 trades means you lost 15,000. The 4 trades you won means you won 40,000. Your weekly profit is $25,000. Depends on your lot size, right? So it just depends on what you're trading. You're trading on a prop firm, a broker. It depends, but it's very, 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 it's not as difficult as you guys may think. The difficult part is figuring out what your lot size should be, and most importantly, should I get in this trade and stay in this trade? Like, that's the hardest part. If you see yourself up $1,000 and your goal is $1,000, you know how hard it is to, this is the hardest part of trading. You know how hard it is to have your goal be, oh, my goal is to make $1,000 every single week in trading. And then your first week in trading, you make $1,000. Tell me, as you're watching this video, if that happened to you, would you close the trade and be like, I made my goal, I'm good, that's it? Or would you get greedy and be like, you know what? What if this gets to 2,000? Maybe 3. It can get to 5. Let's just let it run. That's human nature. Like, you can say, oh, no, you wouldn't. If it got to 1,000, you'd probably be like, yo, it got to 1,000. Let's just see if it gets 2,000. Let's just try it out. And then you'll see the market will get to 2,000, or it'll get to 500. It'll get to 0. So that's why it's always good to take profit if it hits your goals. But risk management, this is how you always, I have a deeper risk management video in here that's more in detail. But from a top level perspective, you guys can see flat out, this is how you have a lower win rate, but you're still very profitable. That is the most important thing. So literally, you guys came here in the beginning of the video not knowing how to trade at all, not knowing how to do a single thing when it came to trading. And now after, I don't know how long this video was. I'm hoping it was, I guess, an hour or less. It could have been longer. I don't know. But regardless, you guys now know how to trade on its basic form. And that's the easiest part. Or sorry, that's the hardest part. Everything after that is just easier. It's just honing in on everything you just learned and going into detail about it. But if you guys are still here at this moment, the last round of applause I'll give you for number 3 is the hard part is actually over. Everything from this point on is going to become easier. It's going to become difficult moments, but everything becomes easier in a sense of, I already know the basics. Now, the more advanced stuff is just everything I taught you guys, but just going deeper into it, having some trial and error, actually trying to get a 1-to-4 risk to reward ratio, looking at pairs that you know is going to go up. You know for a fact it's going to go up, but the stop loss makes it a 1-to-1 risk to reward ratio. And are you going to break your streak of 1-to-4 to chase that one trade and you know it's going to go up and then it actually doesn't go up and goes down? It's just the hard part is over, but now things along the way will still be hard, but not as hard as learning how to trade, which you guys right now at this point, you already know how to trade. Now it's just more so going into deeper into it, which you guys can see on my YouTube channel. And if you guys want some free material that I can send you to you guys exclusively, please click the link in the bio. I'm sending it to people out there who want to learn. Like I said, there's a good amount of free material that I spent a lot of time putting a sequence together for you guys, the perfect sequence for you guys to actually get to where you guys want to get to. So again, if you guys want it for free, click the link in the bio. I'll send it over to you guys immediately. I hope you guys like this video. Like I said, I am exhausted. I need some water, but I hope you guys took away the value that I promised you guys at the beginning of the video, which is how to learn how to trade. Later, guys.